Welcome, and welcome to our conversation about maximizing your impact. It's our guide to strategic charitable giving. My name's Sally Boyle, the founder of S.J. Boyle Wealth Planning. And I want to start with one question, which is, why do you give? Take a moment and think about that, and think about the organizations and causes that are closest to your heart. The one that when you see their work, it truly inspires you. And maybe that was the original reason you started to give charitably anyway. For many of us, charitable giving is a deeply personal expression and talks about what we truly care about and what we really want to influence and where we want to make a difference. It's not just about writing a check, it's about making an impact. And that's my goal today, is to move you from being a generous donor to be a strategic philanthropist. We're going to explore some powerful tools that can help you give more to the causes that you love, while also being smart about your taxes and your overall financial plan. Today, we'll cover 3 key areas. It might be considered strategic giving 101, but it really is helping you understand how to give beyond just cash. And first, we'll explore giving appreciated stock. Now, the problem is you've got stock that's grown significantly in value. And after the last couple of years in the market, with it being on such a tear, that's probably a high probability. But if you sell it, you're going to have to pay a capital gains tax, which can be 15%, 20% federally. And then if you donate the cash, you can only deduct the after-tax cash donation itself. Now, the solution could be for you to donate the stock itself to the charity or to a donor-advised fund. And the benefit is a double whammy benefit. You're going to avoid paying the capital gains taxes, and you're going to get a charitable contribution equal to the stock's full market value. The takeaway here is that this is often the simplest, most tax-efficient way for you to give your money away for most people. And all you need to do, it's very simple, is to contact the charity, ask them if they take stock directly, and then ask them about the process. It's really that simple. And then you tell your brokerage account to send the stock directly to the charity. Simple, effective, and easy. Now, the second way to maximize your contributions to charities is to use a donor-advised fund, or commonly known as DAFs. And a DAF is essentially your own personal charitable savings account, and it's managed by maybe the institution that is sponsoring it. It could be a brokerage institution, it could be a charitable institution, it could be a community foundation. And what you do is you make an irrevocable contribution to your DAF, get the tax deduction in the year that you do that, and then the money is invested and grows tax-free. Then you make recommendations to that DAF where you want the funds to be sent to your favorite charities and when. So the benefit is, for some people, you can front load your giving. And what that means is you can maybe give 1, 2, 3, 4, 5 years worth of giving into a donor advised fund in maybe a high tax year for you. Maybe you've had a high income year, maybe you've sold something. And so you can maximize the tax deduction in the year that you need it, but still give to the charities in the years that you want them to receive it. So it's a very simple tool for you to consolidate your giving and use those dollars in your DAF to grow tax-free, and then give to your charitable institutions when you're ready. Front loading can also benefit others in different ways. It can be used by those people who don't itemize their deductions. So let's talk about how that might work. It's really what we call a bunching strategy. And we know that since 2017, the standard deduction has been high enough that most people aren't even itemizing their deductions. And in order for you to take your charitable contribution as a deduction, you have to include it in your itemized deduction. So if you're not itemizing, you can't, your charitable deductions have zero tax benefits to you. Now, as I said before, that's not the primary reason that we give to charities, but wouldn't it be great for you to be able to give to the charity and retain a tax benefit as well? So once again, the solution is to take maybe 5 years of contribution. Let's assume that you give $5,000 to your charities on an annual basis. Well, in this case, what you would do is maybe take 5 years of those $5,000 and put it into a donor advised fund in 1 year for a $25,000 contribution. And when you put that together, if you're single, that's higher than your standard deduction. But if you put that together with other things like your mortgage, where alone it's not enough to itemize, or your state and local taxes, you can now exceed your standard deduction and take your itemized deductions versus your standard deduction, which would allow you to take that large charitable contribution as a deduction. Now, in the next 4 years, what you're going to do is you're just going to take your standard deduction because that's the one that's most beneficial to you. But those same 4 years, you're going to be giving whatever donations you generally would have given to your charity so that you get the deduction, but your charities still receive their regular support and maintain the consistency that they rely on from you. So the ability to time your deduction while sustaining your giving, it's what makes donor advised funds practically revolutionary. Now, DAFs can also work for families who are looking to create an enduring charitable legacy. And it's a secure way for their children and grandchildren to maybe continue the philanthropic mission that the parents had established for years, but without the need to use a private foundation. And this is what families have used in the past. But private foundations are complicated. They're expensive to set up. They have annual tax reporting requirements. They have limitations as to the amounts that they can give away based on adjusted gross income. And they're just complicated for successors to take on afterwards. There's some training and learning that has to go on. So strategic donor advised funds can be a solution for legacy bunching as well. Maybe a family has a large liquidity event in any particular year where they're selling appreciated assets, and this could even be private stock as an example. And they make the decision that they're going to contribute these assets into a donor advised fund today. So they get immediate tax deductibility and they avoid the capital gains tax. The money is then invested and grows tax-free for generations, establishing a permanent corpus for their charitable legacy. And the family just simply names the children and the grandchildren as the successor advisors on these accounts. So the next generation can then begin to continue making these grant recommendations for years. And then the founders have had time, because they've established the donor advised fund during their lifetime, to teach their children about philanthropy, about vetting charities, about connecting them with family values, without ever having to manage the complex legal entity. So, or file a tax return or worry about a 5% distribution rule. So bunching a large contribution into a donor advised fund today not only maximizes the current tax benefit for the family, which might be trying to use this as a way to manage appreciated assets, but it also creates a lasting multi-generational philanthropic legacy with maximum impact and minimum administrative headaches. So we've talked about bunching and the benefit of bunching both for current and future generations. So let's talk about a third strategy, which is really something that is geared for retirees. And this is a tool that you can use if you're 70 and a half. The mechanics are that you will transfer directly from your retirement account to your charity. And in 2020-25, you can transfer as much as $108,000 directly from your IRA to a qualified public charity. And this is called a qualified charitable distribution. Now, there's a huge tax benefit associated with this because the distribution is excluded from your taxable income. It's not a deduction. It's never money that reaches your return. And if you're 73 or older, a QCD can qualify towards satisfying your required minimum distribution. So for those folks who have RMDs that they really don't need, or even a portion of a required minimum distribution, it saves you the tax on that mandatory withdrawal and also benefits your charity 100%, not after tax. Now, the catch is the current law states that you cannot use this QCD to contribute to a donor advised fund or a private foundation. It's got to go directly to a charity. Now, the final thing I want to talk about is legacy giving. This is really the final act of generosity or giving. It may be a charitable contribution through your will or your trust. It can also be where you're using other assets to give to your charity. And the simplest form of legacy giving is naming the charity or a donor advised fund to receive a specific dollar amount or a specific percentage of your estate. Now, the most efficient assets to use for these would be to use your retirement assets for your charity. And this could be the best choice for you. Because remember our discussion of IRAs. When a retirement account comes to a beneficiary at your death, it's considered income in respect of a decedent. And when an individual inherits them, they've got to pay income taxes on them. So if you are charitably inclined at your death, you might choose your retirement assets to go to your charity and leave your other assets to your heirs, because the charity, again, receives the benefit tax-free, and yet you eliminate the tax burden on your family or your children. It maximizes the impact to your charity, minimizes the tax benefit to your family, and leaves your more tax-friendly assets to them. Maybe it's a retirement account or cash or a brokerage account. Now, you can also give other assets to your charities as well. You can give a life insurance policy, you can give a piece of real estate, and these are also very simple ways to leave a lasting impact without impacting your cash flow. Now, we've covered a lot today, but I want to leave you with 3 action items. First, take a look at your assets. If you made a decision you want to give away to charity this year, take a look at the assets and what is available to you to give. It could be cash, but if you review your portfolio and you see appreciated stock, that might be the most efficient asset for you to give to your as a charitable contribution. So look at your investment accounts and see where you can, implement a more tax efficient strategy this year. The second thing would be to talk to your advisors, where it's your tax preparer, your financial advisor, and ask them if a qualified charitable distribution makes sense for you. And then think long term. Review your estate plan and ask yourself, am I charitably inclined? Is there something I'd like to add to my estate plan that would benefit the charity of my choice? And if so, what is the most tax efficient assets I can give to them? And then the most tax efficient assets to my family. And then revise your estate plan if it's indicated. Charitable giving is very satisfying. And it's an incredible way for you to reflect your values both during your lifetime and at your death. And so combining your generosity with some good financial planning, if you do that, you can make a significantly greater impact by just improving even the tax efficiency of your giving. So I appreciate that you visited us and you took part in this discussion. And if you liked what you heard, please follow us. We have content like this every other week. And if you have any questions or comments, please leave them below because I respond to all of them. More importantly, I hope this has helped you amplify your giving and the impact that your giving will have on the charities of your choice.